In this chapter, we're going to look at a range of different types of decisions that a business could have to make. And we're focusing on short-term decisions. So, for example, the issues around whether you should make or buy a particular component, or outsourcing decisions, sending your IT, for example, to an outsourcer rather than doing it in-house. Now, questions in this chapter are likely to involve calculations of what we call incremental costs and revenues. So a cost-benefit analysis. So it's very important that you understand the concepts of relevant costs. So we're going to start by looking at what we mean by relevant costs and then move on to the various different types of decision. As usual, with any of these types of techniques, you need to be able to do them, but you also need to be able to discuss the factors that would be taken into account when making these types of decisions.
So, in order to be relevant, a cost has to fulfill these things. It has to be something that happens in the future, it has to be a cash flow, and it has to be incremental or specific to that particular decision we're taking. So relevant cost will always be one of those three. It might also be an opportunity cost. Now, an opportunity cost is the value you lose out on by pursuing one course of action as opposed to another. So if, for example, we made chocolate bars, let's suppose we make the Mars, and we've got a new opportunity that comes along for a new product called the Venus. Okay, now, if we haven't got enough capacity to make the Mars and the Venus, we will have to reduce our production of Mars to make those new Venus bars. So the contribution that we would miss out on from the lack of those Mars bars would be a cost of our decision for making the Venus. So that is an opportunity cost that we would need to consider. Now, you know, it's also mentioned here avoidable. Really, avoidable costs, just another piece of terminology really. Incremental, specific, avoidable, costs that we only do spend or revenues that we get depending on our particular decision that we take. The term avoidable generally gets mentioned if you're looking at shutting down a division, ceasing production of a particular product line. Okay, but again, sort of incremental specific wraps it up quite well. Now there, what makes a cost relevant? Some of the non-relevant costs that get examined, sunk costs, basically these are things that are in the past, you've already spent that item, it's not in the future, not relevant. Okay. Committed costs are also not relevant. So if we have a commitment to do something, that commitment was in the past, so therefore we're not able to change anything in the future, so it's not relevant. Particularly watch out for here materials. If you've got a long-term contract, you could be told that you've agreed to buy X amount of materials at a particular price. That was agreed in the past for whatever materials you were due to buy for your other production, so that wouldn't be a relevant cost for our future item that we're considering. The other area, notional costs, so things like depreciation. Other thing to watch for here are your overheads. Okay? The only overheads that are relevant are variable overheads or specific fixed costs. So we only incur this particular fixed cost if we do this particular project. So any general fixed costs, any allocations, any apportionments of overheads, none of those are relevant. Okay, so that's these sort of broad categories for what makes a cost relevant or not. Now you can apply those to any of our 6 decision-making scenarios that we may be faced with in the exam. What it's also worth looking at are some specific situations for materials and for labour to work out what's relevant within those specific scenarios. So if we have a look at materials, so let's go back to our Mars bar and Venus bar example. Let's suppose we're going to make some new Venus bars and we need some cocoa in order to do that. The first question that we need to ask ourselves is whether or not that cocoa is in stock. Now, if it's not in stock, we've got to go and buy it, and therefore the relevant cost is just that current replacement cost, the current purchase price, whatever we've got to go and pay for that cocoa. Now, if the cocoa is in stock, we need to understand a little bit more about it. We need to know whether it's in continual use. If it's something that we use all the time, so our cocoa, well, we use it for our production of our Mars bars, if we're going to take some of that and use it for our Venus bars, then we're going to need to replace it because we need it on our everyday production. So because we've got to go out and replace it, we've got to go and buy some more. The relevant cost is again that current replacement cost, that current purchase price. If we've got the cocoa in stock, but we've got no other use for it, so let's say we'd stop making Mars bars, we weren't using the cocoa anymore. If we use it on production of our Venus bars, well then we haven't got to go out and replace it because we don't need it anywhere else. Now under this scenario, the relevant cost could be nothing or the resale value. Now what I mean by the resale value is if we were able to scrap the material, we're able to sell that cocoa to somebody else and get some income for it, that is a cost to us because we're now not going to be able to get that income if we use it on production of the Venus bars. If we can't sell it for anything, then the relevant cost would be nil. Okay, so whatever your current resale, current scrap value is, that would be your relevant cost in this scenario. Now, if we have the item in stock, but you're told it's scarce, or you're told you can't go out and buy any more, if we use it, you haven't got an option here, we can't replace it. So what that means is, if we use it on Venus, we cannot make any Mars bars because we can't buy any more cocoa to do that. So the relevant cost in this case is that lost contribution from the sale of Mars bars that we can't now make, our opportunity cost. So let's have a look at example 1. It's just a little example which looks specifically at material. We've got to work out the relevant cost, X and Y, that we're going to include in our contract cost. Now our contract needs 400 kilos of X and 200 kilos of Y. We're given various cost information about these two materials and then again some additional information. In terms of that additional information, what we're told is that X is no longer used by the company. Y, on the other hand, is regularly used. Now, as soon as we see this data, this tells us what we need to know in terms of working out our relevant cost. And this is where I would go to first, rather than the detailed cost information. From our little diagram we've just seen, we know that if something is regularly used, we have to go out and buy more. So what we're looking at here is the current replacement cost or the current purchase price. If something is no longer used, we don't need to go out and replace it. So what we're looking at here is the current resale value. Now, armed with that information, I would then go and look at the financial data. As soon as you see historic costs, always ignore it anyway. You never want to get drawn into that because that's in the past. So let's have a look at X first of all. For X, we know we need 400 kilos. We're told that we've got 300 kilos in stock, and those 300 kilos, we've identified that the relevant cost is the resale value, and our resale value here is $2.20 a kilo. Okay, so that element there is $6.60. But obviously that's not all our material. We need another 100 kilos to get to our full requirement. Haven't got those in stock. We must just have to go out and buy those. So we are going to be picking up our current purchase price, which is $3. So our relevant cost for X is $9.60. So for Y, we are told we need 200 kilos. Now we know with Y that it's regularly used, so I'm not concerned as to how much I've got in stock because I've got to go out and buy more of it anyway. So I'm just going to look at that current purchase price, which is $2 a kilo. So I know that my relevant cost for Y is 400. Now let's look at something similar for labour. We need some labour to make our Venus bars. Well, our workforce will either have some spare capacity or they won't. Now, if they've got spare capacity, what that means is we're paying them to work, let's say, a 35-hour week, but actually they're not that busy. They would be able to take on some more work. Now, we don't have to pay them anymore for taking on that extra work. So if you have spare capacity, the relevant cost of that is actually nothing. Now, if on the other hand your workforce are at full capacity, they cannot undertake that work. Now we have to consider whether or not we can get some additional labour to do that. It may be that we can hire more staff or we can work some overtime. Now if that's the case, the relevant cost is the current rate of pay or whatever it is we have to pay these guys to work the overtime to fulfil that contract. If, however, we cannot hire any more staff, then if we make our Venus, we can't make our Mars bars. So the relevant cost here again is an opportunity cost. Now the opportunity cost here is not just the lost contribution, but also the variable cost of that labour. We've still got to pay that labour, so we still incur the variable cost, but we're missing out on that contribution from our Mars bars as well. So example 2 is looking at relevant costs and labour. Specifically here, we want to know the cost of using 15 hours of labour for our contract. So the information we get given, we need 15 hours, labour is currently at full capacity, producing X, and we then got our various details about X. Now there's not much detail here, we haven't got any other information about other products we want to make, whether we can access more labour or not. Now full capacity, we know we can't undertake the work ourselves. As we're not told about access to other labour, we have to assume that we cannot get any more labour. It's always worth stating your assumptions, particularly in this kind of question, relevant cost question. There's often marks going for your assumptions or for you stating why a cost is or isn't relevant. So let's have a look at what the cost of these 15 hours would be. So we know we're looking at an opportunity cost. So we know that what we need is the variable cost of the labour, and then we want any lost contribution. Now look at the variable cost first, because that's generally the easiest bit to do. We know we need 15 hours, and if we go to our cost card, we can see here that we're paying $6 for every hour. So 90 is my variable cost. I've then got to work out my lost contribution. Need a little bit of work to do that. So I'm going to do a little working. Always cross-reference your workings to your answer. Always show your workings in order to maximise your marks. Now, what we need are 15 hours of labour. And if we take those, that means we cannot make units of X. Now we know that each unit of X needs 5 hours. So if we take 15, that's 3 units that we cannot make. So let's capture that here. So 15 hours required. X uses 5 hours per unit. So therefore 15 over 5, 3 units we cannot make. Now it's always worth just jotting down your work like this. It doesn't take much extra time, but if you do something daft or you've used a calculator and you key a wrong number in, at least you can still get the marks for your method there. So we are going to be losing out on 3 units. And we can see here that the contribution that a unit makes is 25. So 3 at 25 is therefore $75. So we put that into calculation up here, we can see that the relevant cost of our labour is $165. Now there are different ways you could approach this particular question. This is consistent with that overview diagram we looked at. Depends how your mind works really as to kind of what approach you prefer, and often with management accounting there is more than one approach that you can take. The alternative that you might have used, you could have said, well actually I know that I am going to lose my 3 units of X, so essentially you are repeating work in 1 here. So we lose 3 units, and what we lose are the revenue. Now if we go back to the question, we can see that the selling price was $75. So we lose 3 units at 75, which is a loss to us of 225, but we save the material cost. We've still got to pay the labour, but we do save ourselves materials. $2 for a kilo of material, 10 kilos needed in total, so each unit needs $20 worth of material. So we're saving ourselves 60. So therefore again the cost to us on a relevant basis of the not having enough labour to make our other units, again 165. So example 3 deals with the first of our short-term decision types, and that is an accept or reject decision. What we have to do is prepare a statement of relevant costs and revenues and determine whether or not the proposal should be accepted. Now, this is a kind of typical layout to these questions. You've been given here a particular proposal which basically says you shouldn't do it, it's making a loss. You then get given further information. So basically you have to redo this statement using relevant costing principles. So let's just have a look at the detail involved. We've got to manufacture 12,000 units of tea, selling price of $3 per unit. We've then got our statement, sales revenue, all of our various costs. Now, what I suggest you do here is just work logically line by line through each of these, deciding whether they're relevant or not at each step of the process. Now, the first thing we've got here is the income, which obviously is entirely relevant. So let's start our statement. We will bring in our sales revenue. And what we had here was 12,000 units, and the selling price is $3 for each. So we've got income here of $36,000. Next up, we've got material X. Now, we're given here the historical cost. Ignore that. We know we don't want to pick up anything that's in the past. So let's have a look at the further information. Material X cannot be used or sold for any other product. Now, if that's the case, we don't use it anywhere else. If we've got some items in stock, what we're looking at here is the resale value. Now, in this particular scenario, we don't have a resale value. We actually have a cost to get rid of this particular item. So if we use material X, we are saving ourselves that disposal cost. It's a slightly unusual one, that. So let's bring in our costs. So we've got material X, which is actually a saving. I'm going to put that in brackets because it's not a cost, it's a saving. So next up, we've got material Z. We're told the contract price is 9,000. Well, what else do we know? Each unit of new production uses 2 kilos of Z. Long-term contract, well, we know that that is not irrelevant. So, regularly used, therefore we want our current purchase price, and that is 17.5 cents a kilo. So let's bring that into our statement. So we've got material Z. We need 2 kilos for each unit. And we know that we're paying 37.5 cents for each. So it comes out at 4,200. Next up in our statement was our labour of $10,000. So let's see what extra information we get about our labour. No, that's not note 3, that's note 4. So don't forget note 3. Let's look at note 4 first of all. We need skilled labour, which is scarce. If product T were not made, the labour could be used on other activities which would yield a contribution of 1,000. So if it's scarce, what we're looking at here is an opportunity cost. And remember, that is your variable cost plus your lost contribution. So our labour, we've got the variable cost, which we can assume is the 10,000 that we were given in the statement. And then we've also got our lost contribution, just abbreviating there, of 1,000. Okay, next up in our statement was depreciation. Well, we know that depreciation is not cash, so that is not therefore going to be relevant. However, there was something to do with that machine in note 3, so let's just have a look at that. The machine would be used to manufacture tea. It was bought 3 years ago for 22,000. Well, that's irrelevant. Scrap value 2,000. The new product is not manufactured. The machine could be sold immediately for 7. If it is used for a year, then we'd sell it for 4. So, in terms of the scrap value, the purchase price, the depreciation of the machine, none of that is relevant. But we do have some information here which is relevant. If we don't make product T, we're going to get $7,000. If we make T, we will sell the machine later, so we're not going to get 7, we're going to get 4. So we've got here a loss, $3,000 if we make T. So that is a cost that is specific here to our decision. So let's bring that in. So loss of machine proceeds, that is 3,000. Variable overheads at 30 cents a unit. Well, if they're variable, then they should be relevant. Just check whether there's anything in your additional information which gives you any extra. No, nothing there, so we can put all of our variable overhead in as being relevant. Now there was no additional information now. The only thing left in our statement are the fixed overheads, and note here they are absorbed at 80% of labour. It's not cash, it's just an apportionment, so that is not relevant. So we've dealt with all of the relevant items here. So if we work out now what the outcome of this product T proposal is, $21,600 comes off of our 36,000 of income. It leaves us with a positive 14,400. So because this is positive, you would accept the proposal to make product T. Now example 4 focuses on make or buy decisions. What we have to do here is consider whether we should make or buy our components, and then what other factors should be considered before we make that final decision. Now if we just focus here on whether or not we should make or buy, we need to consider the relevant costs. Now they're all the specific costs of us making these items. We can see that the contractor has offered to give us P for $12 and J for $21. Our variable costs of production are 11 and 17. So clearly the variable costs are less than what the subcontractor has offered. However, what we need to consider here are our other fixed costs. Are there any that we would save if we didn't make P or J? So if we look at the fixed costs that we've got here, we can see that we've got some that are incurred directly from making P and directly from making J. If we therefore don't make these products, those costs will cease to exist. So as well as the variable costs, we need to take into account these specific fixed costs when we make our decision about whether or not we accept the subcontractor's offer. So have a go at calculating the relevant costs in this decision and working out whether Mars should make or buy those components. Once you've done that, have a think about the other factors that they should consider before making a decision. These can be financial, they can be non-financial. So let's have a look at the answer to example 4 then. We saw that it cost us an extra $1 to buy P from the subcontractor and $4 from J if we compare that with the variable cost of making those units. But we've also got those specific fixed costs that we would save. So gross up your variable costs for the amount of units you would be making for P and J, 1,000 and 1,500. So we can then compare the extra variable cost of buying with those fixed costs that we would be saving. Now what we can see here is that if we were to subcontract P, we would actually save $500. If we were to subcontract J, that would be more expensive than if we made that ourselves. So your recommendation here should be to subcontract P only. And the other considerations that you might want to think about, what you would do with the spare capacity. Are there any impacts from subcontractor producing P? Will it have a knock-on effect to your production of J? What are the impacts on your customers? Will the subcontractor be reliable? Will the quality be good? Will they be flexible enough to be able to respond to changes in demand? Are the estimations about those fixed costs that are specific, are they realistic? So there's a whole host of things you can mention there, both financial and non-financial. Make sure that you can think of all of those aspects, and obviously if you get that in the exam, you'd be wanting to make one of those points for each mark that was available.
What we need to do here then is to consider the information in the scenario and firstly determine if the K production line should be closed down. So on first glance then, production line K has a loss, a net margin of minus 10,000. So the directors then are thinking about closing it down because of the losses that have been incurred. What we're going to do then is determine whether or not that loss means that it should actually be closed down. Secondly, then we need to think about other factors that should be considered prior to a final decision made. So it's important then in the exam that you can think about non-financial factors and other factors that can affect the decision other than the relevant cost. So we need to think about what costs then would be avoided if the production line for K was closed down, and which ones then would be incurred regardless. So we need to have a look at the different types of costs. Now, if the K production line ceases, then that means that the sales will be lost. So the sales then of 600,000 would be lost, but they would save production costs. So you'd save the material costs of 200, the labour costs of 95, and those variable overheads of 75,000. Also, if the production line was closed down, the selling costs would be avoided because these are commissions. What we need to consider though are those fixed overheads. Fixed overheads consist, it says in note 1, of an apportionment of general factory overheads. General factory overheads then are never going to be relevant costs. They would be incurred anyway. So the only ones that will be saved are those which are specific to the product. The fixed overheads then which are not specific to the product are 80% of the material costs. So what that means then is that 160,000 of fixed overheads are general overheads. So therefore 50,000 are going to be specific and would be saved. So we can have a look then and see what would happen if they cease the K production line. We would end up then with an additional loss of 150,000. So the company would be worse off if it closed down the K production line because it's making a positive contribution. So it would lose a positive contribution of 150,000 if it closed it down, because those fixed costs would be incurred anyway. So it shouldn't be shut down because it makes positive contribution. Secondly, then, in part B, we need to think about other considerations that the company might want to make before deciding to shut down a production line. So here then, the K accounts for 54% of the company's revenue. It's very likely then that if they did decide to shut that down, the other costs would also change. So we've assumed then that the fixed overheads would be incurred regardless, but it's likely that they would have other costs changing. They might need, for example, to rent less space. The other thing is we don't know what these products are, K, L and G, but it could be that there are interdependencies between the products. So it could be that sales of one product are very closely linked to sales of another product in the range, especially if they're complementary products. There could be alternatives to closure. For example, they could decide to reduce the commission that was paid to the sales staff, because that would have the possibility of turning this into a profitable division. There are costs associated with closure as well, which haven't been considered, and they would probably make it even more in favour of staying open. So, for example, redundancy costs, and also there might be asset write-offs and other capital costs associated with closure.
Section 7 covers minimum price scenarios, and again they're dealt with in exactly the same way as all of the other scenarios we've seen. You'd probably be given an initial price, much like you saw in the accept or reject decision, and you'd have to come up with a new price, or it could be you'd just be given a whole host of information. You had to come up with an appropriate minimum price for that particular project. Now, the key thing here is that your minimum price must just be the relevant cost of that particular product or project. Don't ever add anything on for general overheads or for a profit markup. Now, it may well be that people choose to add those on when they finally set their price, but the absolute minimum is just enough for you to cover your relevant costs. The questions always talk about the fact it's company policy, you always add on a markup or whatever it might be. You just ignore that totally, only cover your relevant costs. So the final decision making type that we have to deal with are joint costs and products. These tend to follow a slightly different format to the other situations that we've seen so far. Basically, our products go through a process, and at the end of it we can get several products out at the end of that process. Now, one of the key decisions we then have to make is whether or not we process those items further, or whether we sell them immediately they come out of that process. So I'll just give you an example. Let's suppose we had a timber mill, and we've got our timber in that process. We could sell, the minute it comes out of the timber mill, that timber is just sawn planks of planed timber. We might, however, decide to process it further. Maybe we set up a division that actually makes furniture, and we might choose to sell that timber as tables and chairs at the end of that process. Now, what's key here is understanding these joint costs, whether they are relevant or not. Okay. Now, basically, the joint costs are not relevant if you're looking at processing a product further. They're in the past, they've happened, they make no bearing on what you choose to do in the future. So never bring in those joint costs when you're deciding to process your product further or not. The only time those joint costs might be relevant are when we're understanding whether or not we should be operating that process at all. Example 6 is a nice straightforward little example just to illustrate the principles involved in this kind of decision. Obviously, the questions that you get in the exam in this area will be more involved than this. We're asked here which product should be processed further. We've got our 3 different types of output: selling price if we sell them now, the selling price if we sell them later on, and any additional costs we're going to incur in order to do that. We're also then told that our joint processing costs are 20,000. Now remember, that is irrelevant to our decision. It is in the past. We're not going to influence that 20,000 by our resulting decision to process further or not. So in terms of the decision we are interested in, what we're going to do is compare our net revenue now with the net revenue that we could get later. So let's bring in our 3 products, X, Y and Z, and we'll look at the revenue that we can get if we sell them now. Now you could do this by units, but then you'd need to get your post-separation cost down to a unit basis as well. So I'll gross these up here and keep everything in a gross level. So we've got 2,500 units of X, selling price at separation is 3, 1,500 units for Y with a selling price of 5, and 2,000 units for Z with a selling price of 8. So the revenue here that we get now that's if we sell straight away. I'm going to compare that with what happens if I choose to process further. So my revenue would be, get $5 a unit now for X. I get 10 for Y. And I now get 15 for Z. Okay, so my new levels of revenue, but obviously in order to do that I need to spend some more money. So if I bring in my post separation costs, just abbreviate that there, 10,000, 8,000, 12,000. Okay, so my net revenue, 2.5, 7, and 18,000. So basically I am going to compare this net revenue column there, sorry, just gone over that one there, with my revenue column here. Now what I can see from X is that I make more money if I don't process further. For Y equally, I make more money if I don't process further. For Z though, I make an additional 2,000 if I do process further. So on this analysis, I would process Z further. That's the only product that I would choose to do. So in summary, key things from this chapter, basically the principle of relevant costing. Now remember, relevant costs have to be future costs, they need to be cash flows, and they need to be incremental or specific to your decision. They may also be opportunity costs. Key things to ignore in a relevant costing decision: sunk costs, any committed costs, any costs that are just apportionments. The other thing to remember with relevant costs is that before making a final recommendation, you should give consideration to any other factors before making your decision. So any qualitative factors, thinking particularly about the impacts on your customers, your suppliers, your employees, and the competition.